divorce lending professional. And I'm super excited to chat with her today because I didn't know that CDLPs existed until a couple of years ago. And I was really excited when I found out what that even means because lending is kind of this big mysterious thing. But lending, when it comes to divorce, there's some nuances to that, there's some complexity to that. And so, working with someone who is an expert in the divorce aspects of lending, that's an incredibly valuable resource. So, I'm super excited to chat with you. So, thanks so much for joining me.
Yeah, well, thanks for having me, Rachel. And I'm just really happy to be here with you today and just talk to you a little bit more about what the CDLP certification is and also how I really think it can be a benefit to our divorce clients.
Yeah, that's awesome. So what do you think the benefits are to working with a CDLP as opposed to just working with a regular lender?
Yeah, so the CDLP certification involves, additional coursework and knowledge into really some of the specific divorce lending guidelines and understanding a lot of the specific unique issues that involve divorcing homeowners. So it's really having that additional knowledge to help this unique clientele as well as expertise. Regular mortgage lenders, they may deal with divorce clients, infrequently or just once in a while. Whereas, 95% of my clientele are divorcing homeowners. So I just really see a lot of the common issues and the unique, aspects of the divorce that I can really help with. And it's similar to you, Rachel. Um, People come to you because you're a divorce specific financial planner. You really see and understand their issues and have the knowledge and expertise to help them versus a traditional financial planner. So a CDLP is very similar to that too.
Yeah, over the last few years, I've really learned that using professionals who have a specific specialty like divorce, I don't know, I just think that you get the best quality advice when you're getting advice from someone who that's their whole world. And it's not a once in a while thing. They do divorce stuff all the time. And I just think that, I think you can get good quality advice outside of that as well. But I'm a big fan of the specialists and especially when it comes to our industry, at least, because it's just so different. Divorce is like its own world.
Yeah, absolutely. And like you understand, there's a lot of other issues and professionals involved. There's definitely the family law aspect. There are tax issues. There are retirement planning issues. It's a big qualifying event in someone's life. So, it really can't be treated the same as a traditional sort of event, or in my case, traditional purchase or refinance transaction. There are just a lot more involved. And I think to serve our clients well is to really understand all those aspects together. So that is why I'm a big fan of the CDLP designation. And, my focus in my practice is to really help these clients.
Yeah.
Mhm.
So I think maybe it would help if we talked about some specific, maybe questions or issues that come up among divorced people, because I know I get a lot of the same questions when it comes to lending that I love to hand off to someone like you. But so I would say that the most common scenario that I'm hearing of right now is, maybe a couple bought a house several years ago when interest rates were low.
Mhm.
And now one wants to buy the other out and they need to refinance the loan into their own name. And interest
Mhm.
rates are higher than they were. And maybe the new payment wouldn't really be affordable for them. I feel like that's a super common concern that I'm hearing. And what do you have to say, to someone who's concerned about that?
Yeah, absolutely. I mean, obviously, we're in a higher interest rate environment right now. That's definitely changed over the last year. And that's a very valid concern that people have. And so when I talk to my clients about this, I really try to focus on, what we have control over and what we don't have control over. So we don't have control over where the interest rates are right now. That's determined by the Federal Reserve and central banks. But what we do have control over is, what is the budget? What is the cash flow for our clients? What can they afford for a mortgage payment that's reasonable? So I really have that, we really look at, what their income is, what their debts are, what that monthly budget is. And then I try to find a mortgage product that can really fit their needs. And sometimes that may mean, a different product than a traditional 30-year mortgage. It may be an adjustable rate mortgage or maybe an interest only mortgage, just really being creative with those solutions that fit those needs. And then I always remind people, you're not locked into this interest rate or this mortgage product forever. If and when the interest rates get better in the future, we can always refinance, but this is just what, is good for your needs right now.
Yeah, that's
Mhm.
good. It's good to know because I think sometimes people feel like they don't have options. Like, oh, I can't keep the house. And it's like, well, it just maybe looks a little different than you had expected, but maybe this
Right,
is doable.
right,
Um,
exactly.
and then another thing that I see is not really understanding how they would qualify for a loan now that they're going to be single, and maybe they weren't working before, and maybe their income is from support, or
Mhm.
maybe I don't know, maybe they didn't have the best credit on their own because they were just maybe their ex was the one where all the loans were in their name or something. Do you run into that situation where they kind of struggle to qualify?
Yeah, again, like this is why I think divorce mortgage planning is different than a traditional transaction because traditional transactions, you may be refinancing or purchasing with a partner and you're looking at dual incomes. And usually my divorcing clients are now trying to qualify on one income. And that income might include support income, child support. And you would think, okay, yeah, that's money that's coming in every month. I can use that to qualify for a mortgage. Well, not necessarily. Their lenders look at income much more differently than we would. They need to see a paper trail of, how long you've been receiving this income, how long it's going to continue for. So it needs to be documented in a certain way that it can actually be counted as qualified income. And then also, return to work issues are a big one with divorce. Some people maybe have been the primary caregiver at home and then after the divorce are looking to return to work. But, part-time income versus W-2, full-time income versus maybe a 1099 or a business owner, those are all looked at differently from a lender's point of view. So we can't just automatically assume that that would actually count as income in the lender's eyes. So those are all things that I look at carefully with my clients when they're trying to qualify for a mortgage.
Yeah. And another thing that I found is starting these conversations with a lender like you as early on in the process. I don't know. I think that as early on as you can is really helpful because what I've seen is maybe it's written into the divorce decree that, wife has 3 months to refinance under her own name or, something like that. And maybe that's not enough time for her support to be counted as income. And once that divorce decree is in place, they can't just go back and change that. So before you're making these plans and you're solidifying the settlement, um, speaking with someone like Joanna and making sure that this is even a possibility and talking about the timeline and the affordability and all that stuff, having those conversations as early as possible, I think is really helpful.
Yeah, and definitely, it's true. It's called divorce mortgage planning. This is, I think, planning in advance is really what is beneficial because you just don't know what options you really have until I think I look over them carefully. And that's the thing. I think for some of my clients, they don't really know, if they can refinance, if they can afford to keep the home, can they do an equity buyout? Those are all great questions and really can affect their divorce, but they just don't really know if that's feasible or not. So sort of having me involved a little bit earlier, we can really look at what those options are. And also, if that's going to be written in the divorce, into the divorce settlement, just making sure that they know that legally they can actually do some of these things before they sign on the dotted line. Yeah.
So, what are some options that you've seen, if someone is not able to qualify all by themselves? Um, are people able to have someone co-sign, like a parent co-sign on a loan, or even like keeping their ex on the loan? What can you talk about kind of the pros and cons of those options?
Yeah. So, keeping the Excel loan, that does happen sometimes, and people do that for various reasons. Sometimes, the spouse that's keeping the home may not be able to qualify on their own to refinance, or maybe they've gotten a really good interest rate and they don't want to give up that favorable interest rate. So it makes sense. However, there are risks to keeping your ex on the mortgage. Obviously, it's the main thing is that you're going to still have your credit tied together even after the divorce. So anytime there may be a missed mortgage payment or default on that mortgage, you're still tied to your ex on the credit. So that is something to think about. And then, if either one of the partners end up in another relationship or with another partner, then they don't usually want sort of the to be tied to their ex on a mortgage. So I have seen some situations where it does work out if you have a certain period of time where you're going to stay on that mortgage together, maybe until your youngest child finishes school or something like that, where you sort of set a limited amount of time to sort of be tied together still on your mortgage. But sort of indefinitely, there are definitely risks to that. And then definitely, yeah, having a co-signer, whether that's a family member or someone else, if you can't qualify right now, or you're just building up your income, or you're returning to work, that could be a good idea for someone who just isn't able to qualify on their own for the time being.
Uh,
Hmm.
Yeah, I think I've had people assume that, oh, well, my spouse will just like stay on it for a while. It's like, well, that's not without drawbacks. Even if it's possible, I mean, maybe that's a possibility, but it's not without its drawbacks. I mean,
Right.
let's say that you're the spouse who's staying in the house and the other one is not staying in the house and they're staying on the loan. I mean, what if they
Hmm.
want to buy another house, or what if you don't make your payments or whatever? It's like, what incentive does that person have to stay on this loan with you? I mean, hopefully they would want to keep you in the house and all that, but
Yeah.
it's not a perfect solution for everyone,
No,
I'm sure.
and yeah, yeah, and to me, it's sort of kicking the can down the road a little bit. It's sort
Mhm.
of like, okay, we're not going to deal with this until later. But there are risks to that in terms of, you don't know what your relationship is going to look like 2 years from now, and then you'll have to be dealing with this house. So, but there are circumstances where it just makes sense, or people choose that. But it's true that you're not really sort of dealing with that, at that time. But it is something that you'll have to deal with eventually. Hmm.
So, what are some other potential issues that you think come up in divorce or after divorce when it comes to lending?
Yeah, so definitely sort of the two things that I talked about, that I think are major sort of common concerns that divorce mortgage sort of addresses are just, yeah, that the qualified income and the return to work issues. So those are really the areas that I work with a lot on my clients, to really try and find all the sources of income that they can use to qualify for, on their own for a mortgage, and making sure all that's tied together well with the settlement agreement, and the verbiage in their settlement agreement. And then again, looking at all the return to work issues, making sure that's well documented, and that they can use those sources of income. And also sometimes getting creative, if some people are getting a lump sum settlement from the divorce, which is pretty common, there are ways to structure that to count as qualified income, but the timing and the way that's structured is also very important. And so really looking at all those sources of income from the divorce can really benefit our clients for their future mortgage financing needs.
Nice. Well, I think that is extremely helpful information. And if anyone wants to reach out to you with questions, what's a good way to get a hold of you?
Yeah, so my phone number and email, I'm available to consult with people. I always also tell my clients, as a mortgage lender, I'm not allowed to charge for consulting or just, looking over people's options. So it really doesn't hurt for people to just reach out to me, look at what their options are. I'm happy to walk them through that, and it doesn't cost them anything. My compensation comes if they actually need to do a refinance or a purchase loan. So it's through the originating of a loan. But just talking to me about looking through the options and questions doesn't cost anything. So I really think I want this to be a benefit and a service for people who really need to deal with this big issue of, their biggest asset usually is that marital home or real property.
Well, great. Well, I will include your contact information in the caption, but I really
Great.
appreciate you chatting with me today, and I hope some people find this information helpful. I'm sure they will.
Thank you, Rachel. It's so good to talk to you today.